PPL Corporation missed Q2 consensus estimates on both the top and bottom lines.
Yeah, revenue came in at $2.11 billion, which, I mean, that is an increase of 4.2% year over year.
Right, but it still missed the analyst estimates. They were looking for $2.19 billion.
Exactly. And the bottom line wasn't much better as far as the consensus goes.
No, it wasn't. I mean, JAP EPS was 30 cents, which is up from 25 cents last year. But their ongoing or adjusted EPS came in at 33 cents.
And the street was really targeting a range of 34 to 37 cents, so it missed that entirely.
It did. But here's the thing. Management reaffirmed their full-year 2026 ongoing earnings guidance of $1.90 to $1.98 a share.
Yeah, keeping that midpoint right at 194.
Right. And despite that double miss on earnings and revenue, the stock actually rose 2.43% after the report, closing at $35.46.
Which is, honestly wild to see play out in real time.
It is. So we need to figure out why you, the listener, just watched the market reward a utility stock that completely missed expectations.
That's a huge disconnect.
Totally. So to figure this out, we're going to walk through the segment margins, the massive capital spend they're doing right now, and the management commentary that just completely shifted the narrative.
Because to understand why the stock reacted that way, we first have to look under the hood, right?
Exactly. Look at the specific regional segments.
Right, and the margin pressures that actually caused the earnings miss in the first place.
Let's start with Kentucky Regulated. Ongoing EPS was flat year over year at 18 cents.
Yeah, and they actually had higher base rates there, but it was completely offset by lower sales volume.
Because of the weather, right?
Yeah, mild shoulder season weather. Plus, they had higher operating costs, so it just wiped out the rate bump.
And then you look at Pennsylvania Regulated. Ongoing EPS actually dropped a penny down to 17 cents.
Which is interesting because they had higher transmission revenues there.
Right, but those revenues just got eaten up by higher depreciation and interest expenses.
Yeah, that's the real story there. Though Rhode Island was kind of the one bright spot.
It was. Rhode Island regulated ongoing EPS rose 2 cents to 3 cents.
Driven by lower operating costs and higher rider revenue.
But pulling back to look at the margins and the balance sheet as a whole, I mean, net income hit $230 million.
With a net profit margin of 10.9%, yeah.
And operating cash flow was $1.14 billion for the first half of the year. But their long-term debt has increased to $19.79 billion.
It's a massive debt load.
It is. I mean, they've already deployed $2.3 billion in capital investments just this year. They are on pace for $5 billion in 2026.
Which is just a staggering amount of capital to deploy.
Let's unpack this, because when you look at it, PPL basically looks like they're running on a financial treadmill.
A treadmill is a great way to put it, yeah.
Right. Like they're spending billions on infrastructure just to keep up.
Yeah.
But then the resulting higher interest and depreciation just eat away their profit margins.
Exactly.
So is this margin squeeze just the painful reality of doing business as a utility right now?
Well, yes. And to understand why, you have to look at how capital deployment works in this business.
Because it's different from tech or retail.
Oh, completely. It is heavily, heavily front-loaded. They are spending massively right now to build and upgrade.
Right.
And when you do that, it balloons your depreciation and your interest costs immediately.
The expenses hit today.
Exactly. The expenses hit today, but the revenues, the new regulatory rate cases that actually reimburse them for that spend, those lag way behind.
So they just absorb the pain in the meantime.
Right. They have to carry those costs until the regulators let them catch up.
Which explains the miss. But if current margins are being squeezed that hard by heavy capital spending, why did retail investors bid the stock up 2.4%?
That is the million-dollar question.
Right. And the answer lies entirely in management's commentary about future load growth and the AI data center boom.
The AI narrative just took over the entire call.
It really did. So let's look at the pipeline. In Pennsylvania, their data center pipeline grew to a staggering 31.8 gigawatts.
Which is just a massive number.
It's a 12% jump just from the prior quarter. And 11 gigawatts are already under signed agreements.
With another 6.5 gigawatts actively under construction.
Right. And then in Kentucky, the pipeline is 13.7 gigawatts.
And most of that, like 11.6 gigawatts, is purely from data centers.
So based on all this, management reaffirmed their target of 6 to 8% annual EPS growth through at least 2029.
Which is a very confident long-term outlook.
It is. But the NVIDIA Energy joint venture with Blackstone is the real wild card here.
Oh, absolutely.
They've secured land for 8 to 14 gigawatts of new generation. Plus, they have 5 gigawatts of combined cycle gas turbines, or CCGT, just sitting in the PJM queue.
Which represents what, like 10 to 12 billion dollars in potential generation investment upside by 2032.
Exactly. And none of that is even baked into their current guidance.
That's the craziest part.
But here's where it gets really interesting, because I have to push back on these massive figures.
Sure.
These numbers were eye-popping. 31.8 gigawatts is insane.
Mm-hmm.
But are these real ironclad contracts? Or is this just hyperscale tech companies basically calling dibs on power that might never actually get built?
Well, what's fascinating here is the reality of this timeline. Because you are right to be skeptical.
Yeah, because calling dibs is easy. Building a plant is hard.
Exactly. The demand is very real. These hyperscalers need power for AI.
Yeah.
But management admitted on the call that the NVIDIA joint venture won't materially impact earnings until 2030 or later.
Wow, 2030.
Right. So the investors bidding up the stock today, they aren't buying current earnings. They are buying into a very long-term, heavily backloaded growth story.
Okay, but that massive long-term growth story carries serious execution risk.
Yeah.
And regulatory risk.
Oh, massive risk.
Like if these tech companies change their minds or AI cools off and they just walk away, who pays for the billions in new power plants?
And that is exactly what regulators are terrified of.
Right, which brings us to the most crucial risk mitigation part of the earnings call. PPL has secured regulatory-approved large load tariffs to protect existing retail customers.
Which is a huge deal.
It is. These tariffs require a minimum 10-year contract in Pennsylvania and a 15-year contract in Kentucky.
Just locking them in.
Yeah, and the tech companies have to pay for 80% of the capacity they reserve, whether they actually use the power or not.
Pay, pay.
Exactly. Plus, they have to post massive upfront collateral and face huge termination fees if they bail out even before construction finishes.
They are basically shifting all the risk onto the tech giants.
So what does this all mean? I mean, it's like forcing a tenant to sign a 15-year lease and hand over a massive non-refundable deposit before you even break ground on the apartment building.
That's exactly what it is.
But even with that, what happens if state regulators just decide to push back on this sheer pace of growth?
Well, the regulatory lag is always the risk. But these specific tariffs are designed exactly to prevent everyday ratepayers, and retail investors for that matter, from holding the bag if a data center project goes under.
And we are seeing the regulatory actions play out right now. The Pennsylvania rate case settlement just took effect on July 1st.
Right, which added $275 million to rates.
And Rhode Island's new rates hit September 1st. In Kentucky, they're waiting on a critical reconsideration decision from the commission by August 14th.
So there are a lot of moving parts with the regulators right now.
There are. And it factors into the valuation risks, too. I mean, Bank of America actually cut their price target from $42 to $39.
Though they did keep a buy rating.
They did. But that cut was strictly based on the timing of these rate recoveries. And then you have Investing Pro considering the stock overvalued relative to its fair value, mostly because it's sitting at a trailing PE near 21.
Yeah, a 21 multiple for a utility is pretty stretched.
It is.
It just shows you how much of this 2030 AI growth story is already being priced in today.
Right. It leaves you with the much larger sort of thought-provoking question to mull over.
What's that?
Well, if regulated utilities like PPL are now tying up massive amounts of capital and securing 15-year capacity agreements exclusively for data centers, what happens to the broader grid dynamics?
That is a great point.
Like, will the traditional everyday ratepayer base effectively become a secondary priority to the hyperscaler tech giants in the utility business model of the 2030s?
It's definitely a shift in who the grid is being built for.
It really is. And it's something we're going to keep watching closely. So stay on top of this and all the other market moves. Make sure to follow the show for our daily earnings coverage.